So let's introduce portfolio theory and analysis. Portfolio theory and analysis. The most important thing is that when you form a portfolio, there are always two key objectives. And the objective number one is to maximize what? Maximize the returns. And the second one is to minimize risk. So we need to know how to calculate the return of the portfolio, and we need to know how to calculate the risk of the portfolio. And we appreciate that portfolio return, that is our RP, is simply the weighted average. I'll call it the weighted return. A portfolio is a combination of investments. If I have security A and security B, when I combine together security A and B, they now form the portfolio. A and B put together, that is the portfolio. So if I have to get the return of that portfolio, maybe I have portfolio of assets A and B. I'll take the weight of A times the returns of A plus weight of B times the returns of B. Right? And if somebody asks about the expected return of the portfolio, expected portfolio return, So expected return of the portfolio, this one equals to weighted expected return. The weighted expected return. So you shall have the weight of A times expected returns of A plus weight of B times expected returns of B. Portfolio return, weight times the return. Portfolio expected return, weight times the expected return. And I know that to get the expected returns of A is the summation of returns of A times what? We come here to expected NPV. Summation of NPV times the probability. So the returns times the probability. Now, come and see that probability, I'll have the summation of the returns of A divided by what? The mean. The simple mean. Total over number. Expected return is like the average. The mean average. Come up with a probability, returns times the probability. And one thing that we should always know, anytime you're talking about the return, you see these returns. Anything you're talking about the returns is like the percentage profit. The returns must always be percentages. It's like the percentage profit. That's how. A return is a profit, right? So looking at that profit as a percentage profit. Hi. So that covers the first objective, to maximize the returns. If you're asked about the portfolio return, you'll have the returns of assets in the portfolio times their respective probabilities summation. Then we need to know how to do the portfolio risk. The second objective, to minimize the risk. Then we tell him that portfolio risk equals to standard deviation of the portfolio. So risk is measured using standard deviation, which equals to square root of what? Square root of variance. Square root of variance. So this standard deviation of the portfolio would be the long square root. Sometimes when I do the long square root, and I click kidogo. Hapo ndani tunakuanga hii. Sometimes you give an opportunity for someone to shine. Or let the shining stay. weight of A squared times variance of A plus weight of B squared times variance of B. So we have weight of A, variance of A, variance is standard deviation squared. So weight of B, variance of B plus 2 times weight of A times weight of B times covariance of AB. Covariance AB. So that is the portfolio risk. If we are able to know, so up and down tena, we need to know how to calculate this, how to calculate this, and how to calculate this. So we know that standard deviation of A equals to summation of returns of A minus what? Expected returns of A squared times the probability. Ndio. Sio ni kama ile standard deviation of expected NPV tumefanya. In this case, now we don't have the NPVs, we have the returns minus the expected returns squared times the probability. If we don't have the probabilities, returns of A minus what? Expected returns of A squared divided by N minus 1. And we do the square root. Divided by N minus 1. So I put upon the number of outcomes. Maybe we expect these returns for 5 years, year 1, year 2, year 3, year 4, year 5. So I do N minus 1 because in an examination perspective, we don't expect a sample size or the population or the size of the outcome to be more than 30. So it's always N minus 1 if it's less than 30. 30 and above, we divide by N. But sio ni mtihani wa kuleta 30 and above. Itakuwa 10 itakuwa tocha. So you can avoid that tormentation. This is for less than 30, where N is less than 30. N is like the number of outcomes. So napewa kitu kama in year 1, year 2, year 3, year 4, we expect the returns of like 12%, 5%, 7%, 9%. So from here, we can get the expected return. Our expected return is going to be 12 plus 5 plus 7 plus 9. We divide by how many years? Very quick. Total over the number. No, total over number. So once we have our expected return here, assuming it's maybe 8, to get the standard deviation of that, maybe the A, it acquired the returns of 12 minus 8 squared plus the returns of 5 minus 8 squared plus 7 minus 8 squared plus 9 minus 8 squared. See on the then the answer that we have, we divide by what? 4 minus 1, which is 3. That's what we mean. But come my example, I don't see how he'll do that. I have 1, 2, 3, 4, 5, 6, 7, back if you get that. Set up a past paper. So it's good to know that you are doing this because we expect the numbers not to go beyond that. It will always be less than that. But if anakuwa mwendawazimu aeke 30 and above, then we'll not divide by n. We'll not divide by n minus 1. We'll divide by n. That's how. Hi, great. So this will give us the standard deviation of A. Will also give us the standard deviation of B. So how do we get the covariance? Covariance of AB. Covariance of AB, we are combining A and B. So the summation of the returns of A minus the expected returns of A. We also bring in the returns of B minus the expected returns of B times the probability. Times the probability. Kama hakuna probability, we divide by what? N minus 1 in absence of probability. So unaweza huko mbele or na cancel huko, unaweza wakati una revise kivyako inaweza backfire. Now alternatively, to get our covariance of AB, we can take correlation coefficient of AB times standard deviation of A times standard deviation of B. So this one is correlation coefficient. As andika R, that's okay. As long as we interpret R inakaa kuwa na swali. Correlation coefficient. That one stands for correlation coefficient. Then you can just say correlation coefficient is a measure of the degree of variation, between assets in the portfolio, variation between assets in the portfolio, i.e., for a perfectly negative correlated portfolio, that is now number one, for a perfectly negative correlated portfolio, correlation coefficient equals -1. So perfectly negative, -1. We'll conclude that statement by saying such portfolio leads to risk minimization. So your portfolio is good because it minimizes the risk. Such portfolio leads to risk minimization. So for a perfectly negative correlated portfolio, correlation coefficient is -1, and it leads to risk minimization. Next. For a perfectly positive correlated portfolio, correlation coefficient is +1. Correlation coefficient is +1, +1. +1. Then you say such portfolio does not change. Such portfolio does not change the risk at all. Such portfolio does not change the risk at all. So the risk before the portfolio will remain as the risk after the portfolio. But then correlation is about how related are these assets. When they are negatively correlated, when the relationship is inverse, that's like a negative correlation, right? Ikiongezeka inapunguka. So we always advise that when you are investing, don't invest in the same industry. Don't put all your money, don't put all your investment in the projects when they are doing well, when something happens, they all fall on the same direction. We always want a scenario where when there's something happening, at least as you're suffering in farm A, you are gaining in farm B. So in simple terms, don't take all your investments and go to invest in the banking industry. Don't take all your investments and go and invest in insurance industry. Don't take all your investments, you go invest in media industry, but spread. As you invest in media, also invest in banking, also invest in insurance, invest in different sectors, so that when the communication industry is affected, all your investments are not at risk. At least there's an alternative investment somewhere that is gaining. Yeah. So as this one is suffering, the other one is making some good profit. Negative correlated. We are kiumia, we are sawa. That's the concept of perfect and negative. Let there be an inverse relationship. So, finally, conclude by saying this next point. Uncorrelated portfolio has correlation coefficient. Uncorrelated portfolio has correlation coefficient of 0. Has correlation coefficient of 0. Kama hakuna correlation, basi correlation coefficient is 0. The next point maybe calculate and put it as an NP to calculate the proportions, of assets, in a two-asset portfolio, proportion of assets in a two-asset portfolio that would minimize the portfolio risk. Into brackets, where standard deviation equals to 0. We simply apply the minimum weighted formula. I.e., mwambie kwa weight of A equals to variance of B minus covariance of AB. Variance is known as standard deviation squared. There. We divide by variance of B plus variance of A minus 2 covariance of AB. Let me explain where that formula is coming from. The weight of A is the variance of B of the standard deviation of B squared minus the covariance of AB. We divide by the variance of B plus variance of A minus 2 covariance of AB. This is where the formula is coming from. Sasa hapa ile tunajiuliza ni nimenyimwa weight of A na weight of B. Na nimeambiwa kuwa the standard deviation should be what? Should be 0. Na nimepewa information ambayo inaweza nisaidia kupata the variance of A. Si niko nayo. Pia niko na variance of B and niko na covariance of AB. Now, in arriving at that formula, they made WA the subject of that equation. So making WA the subject of this inachukua hiyo formula. Lakini kama kata umada wa formula ipotee, tunakuja unaweka kwa. Unamwambia let weight of A be X, weight of B will be 1 minus X because the total weight has to be 1. Yeah, although itakukoroga. So if we can memorize the formula, the better. So if that is the weight of A, weight of B will be this 1 minus weight of A. 1 minus weight of A. Now, after talking about portfolio theory, just like any other topic in finance people a decision, they have to make a decision. We always advise on the best way forward. So for that reason, we need something small on decision making. Decision making. The decision making, we say this. We compare the expected returns of the portfolio. We compare the expected returns of the portfolio with capital market line. We compare expected returns of the portfolio with capital market line, into brackets, CML. CML. So CML is like our benchmark. Then you just say, if ERP is greater than CML, if expected return of the portfolio is greater than CML, we accept since it is super efficient, stroke superior, stroke undervalued. It is super efficient, stroke superior, stroke undervalued. The next point, if ERP is less than CML, we reject. Since it is overvalued, we reject since it's overvalued, stroke inferior, stroke inefficient. Overvalued, inferior, inefficient. Then finally, if ERP equals to CML, it is efficient, stroke correctly valued. It is efficient, stroke correctly valued. The next point is summary. The CML is a straight line. The CML is a straight line that originates from the risk-free rate of return. Into brackets RF, and forms a tangent with efficient frontier curve. EFC. So what we mean is that in decision making yet, this is where it comes from. I have here the return against the risk. So CML is a straight line. Remember, this is about the portfolio risk, which is measured using the standard deviation. Now, let's look at something here. This is our capital market line. Let me look at these three. If this one is A, this one is B, and this one is C. Remember, the objectives are to either to maximize the return or to minimize the risk. When I look at projects A, B, and C, their level of risk we have is the same. The risk level is constant. but their returns are different. So between A, B, and C, which one would you recommend? A, B, or C? Would recommend A. Because it is promising the highest return. Our objective is to maximize the return. So A is maximizing the returns out of the three, right? And when you look at the returns of A, returns zake ziko hapa. Returns the CML ziko hapa. So A promises the returns that are higher than the CML. And that's why you're saying E ni mzuri. Si B ni mbaya, C ni mbaya. Because returns zake ziko chini. Ndio. So compare returns za C za hapa na za B za hapa. So it's giving us a return that is below the CML. So you can even consider it from a different angle. If this was D and this was E. When you look at D, B, and E, the level of return is the same, but the risk levels are different. But between D, B, and E, which one should you recommend? Is it D? Ama E? D. Kwa sababu gani? Ina promise the lowest risk. Ndio. Na ukiangalia D ina promise the lowest risk, returns zake ziko kubwa kwa CML at the same level of risk. So that's why we recommend D and we reject E. So the securities whose returns are above the CML are recommended. They are good because they are either super efficient, superior, or undervalued. Zile ziko chini ni mbaya because ziko inefficient, inferior, or overvalued. When you are investing, do you prefer an overvalued or an undervalued? When you are investing, do you prefer an overvalued or undervalued? Both answers have the word value. You prefer undervalued still. It has space to grow. Yeah. That's what you can say, undervalued is superior, you're mzuri. When you invest in an overvalued, then the only option remaining is losing the value. They're getting it wrong. They'll be getting it wrong. Tupeane formula CML, songe mbele. Tumwambie tu kwa CML equals RF plus RM minus RF divided by the standard deviation of the market times standard deviation of the portfolio. Let's not derive that so much. I check them more in the notes. That is about the portfolio theory. The topic is divided into four. We have portfolio theory, we have CAPM, capital asset pricing model, then we have the multi-factor models and portfolio performance measures. Hi. Let's talk about CAPM. Just bring a summary, capital asset pricing model. Capital asset pricing model, CAPM. Can just say something, say it appreciates that portfolio formation eliminates unsystematic risk. Portfolio formation eliminates unsystematic risk through diversification. Eliminates unsystematic risk through diversification. Hence, only systematic risk should be considered. only systematic risk should be considered instead of total risk. Systematic risk should be considered instead of total risk. And it should be measured, using beta factor. And it should be measured using beta factor. You'll be on as well. Beta factor. Then you say beta refers to the sensitivity of security returns. Beta refers to the sensitivity of security returns to the returns of the market portfolio. The sensitivity of security returns to the returns of the market portfolio. So you're comparing that security with the market. And it is calculated using the formula. So you're looking at our two assets, or two assets A and B. So tumwambie kuwa beta of A equals to covariance of A and the market divided by variance of the market. So you're comparing A with the market. Covariance of A and the market divided by the variance of the market. Do you remember how to calculate the covariance? Formulas for B. So the returns of A minus expected returns of A, returns of the market minus expected returns of the market times the probability. Kama kuna probability divided by n minus 1. Yeah. Alternatively, I can get my covariance using correlation coefficient of AB, standard deviation of A, standard deviation of B. So I want us to have a different inatuanga formulas clearly unazatumia, because what if I have the correlation coefficient? I think let us just say that let us recall that to get the covariance of AM, we can take correlation coefficient of AM times standard deviation of A times standard deviation of M. Right? From this. So if this is the covariance, can I take this formula and replace it at the numerator? So that we might be beta of A can also be correlation coefficient of AM times standard deviation of A times standard deviation of M divided by what? Standard deviation squared of M. Right? So can I cancel this and this? Standard deviation squared is standard deviation times standard deviation, clear. So that niseme kuwa beta of A equals correlation coefficient of AM times standard deviation of A over standard deviation of the market. So I can either use this formula or I can use this formula, depending on the information there. So the two formulas will help me get the beta of security A and the beta of security B. When I bring them together, inakuwa the portfolio. Ndio, inakuwa the portfolio. So tumwambie tu kuwa portfolio beta equals weighted beta. portfolio beta equals weighted beta, i.e. beta of the portfolio equals weight of A times beta of A plus weight of B times beta of B. Weight of A times beta of A, weight of B times beta of B. So the formulas help us to get the beta of the securities or assets in the portfolio. Once I have the beta of A and I have the beta of B, then the portfolio I simply multiply by the respective weights. Great. Can we go to decision making? We conclude that bit. The decision making, you say, we compare expected returns. We compare expected returns with security market line. We compare expected returns with security market line into brackets SML. Then you say, if expected returns are greater than SML, we accept. If expected returns are greater than SML, we accept. Since it is superior, stroke super efficient, stroke undervalued. Superior, super efficient, or undervalued. It's not neither CML. The next you say, if expected return is less than SML, if expected return is less than SML, we reject. We reject. Since it is inferior, stroke overvalued, stroke inefficient. It is inferior, stroke overvalued, stroke inefficient. Then finally, if expected returns equals to SML, if expected return equals SML, it is correctly valued. It is correctly valued. Stroke efficient. Correctly valued, stroke efficient. So SML na CML zinafanana. Tofauti tu ni kuwa CML ya portfolio theory, SML ya CAPM. So everything is the same. So even our SML originate from the RF. And first hapa, the risk is not measured using the standard deviation, the risk is measured using beta. Just say that SML equals, the SML equation, RF plus what? Rn minus times beta. RF plus Rn minus RF times the beta. And you know that Rn minus Rf can also be called what? Risk. Risk premium. Risk premium. Great. Now, We talked about the decision making still. So we talk about the third part, which is the multi-factor models. Multi-factor models. Multi-factor models. Then for the multi-factor models, one is coming after the other. We started with portfolio theory because of the limitations. Because of the limitations of portfolio theory, which considers the total risk. Once we form a portfolio, you don't need the total risk because unsystematic risk is diversified. So you only need the systematic risk. That's how CAPM came into place. Now, even after CAPM coming into place, it only considers a single factor of systematic risk about the market. Other factors, other models came in and said, we cannot only consider one factor of the systematic risk because systematic risk is a combination of many factors. And that's why I say the multi-factor models. So just say they consider several factors. They consider several factors of systematic risk. They consider several factors of systematic risk and appreciates that utility is derived from consumption of returns. Utility is derived from consumption of returns. And not in difference curves. And not in difference curves. And not in difference curves. As is the case under CAPM and portfolio theory. CAPM and portfolio theory inassume the level of satisfaction of an investor is measured using indifference curves. But nasema hapana, it's not about the indifference curves, but it's about how much you're consuming. The more you consume, the more satisfied you become. Then you say, they are of three types. They are of three types. Number A, arbitrage pricing model, stock theory. Arbitrage pricing model, stock theory. So this is the CAPM, arbitrage pricing model, and arbitrage pricing theory. Number B, we have Farmer French model. That is FFM. Farmer French model. And number C, we have somebody called Pastor Sternberg model. So PSN, Pastor Sternberg model. Let me say, according to these models, expected return equals RF plus RM1 minus RF times the beta of the first component. So hii ni SML, single factor. Tunaongeza factors zingine. RM2 minus RF times the beta of the second component. They can even be as much as 10. So plus and do RMN minus RF times the beta of the nth component. It's simply an extension of CAPM. Now, for the arbitrage pricing model, zinaweza kuwa unlimited. For former French model, it covers 3 factors. It is a 3-factor model. It's a 3-factor model. And among these factors, we have the first one, the market, the return on the market minus RF beta of the market. The second one is about the value, big value minus small value, and we have volume. So tutakuwa umepewa the factor sensitivities, that's the systematic risk. Tutakuwa na market, value, na volume. When it comes to the faster standard model, inaanzia kwa farmer French model, alafu tuongeze liquidity factor. So for that reason, the faster standard model is a 4-factor model. Market, value, volume, liquidity. Arbitrage pricing model, haina restrictions. It can even, what does it matter with the inflation? So whatever they give us is what we apply. But the farmer French model and the faster standard model, hizo ziko na masharti. Great. So you can summarize the last part. Don't summarize notes. Next week tunafanya maswali tunamaliza. And the other, after next week we shall be left with the 2 topics: international finance and mergers and acquisition. After next week we shall be left with how many classes? This is how many classes? Natulipa tu mtihani jana. Tunasema how many classes? It's good to do these things and finish. Hi. Can you? Arbitrage pricing model. How big it can cover all, a representative of either of the 3. It's only that for farmer French model, there'll only be 3. So this one is about the market, about the price, about the value, and about the volume. Tatu peke yake. Faster standard zitakuwa 4. Sawa. But arbitrage pricing model can even be 10 or 20 or 2. Hiyo haina restrictions. Sawa. So the last bit, portfolio performance measures. Portfolio performance measures. So in the summary, I know if you have some little courage, not too much courage, you can check the past papers and attempt a question. Because whatever with the summary we are giving, we are summarizing everything that you need to answer those questions. So you can look around the past paper, you get any question, then you say, why can't I attempt this one? Then on Saturday, I tell you, Fuller, mark for me this. Then we mark together in class. So, portfolio performance measures, we say this. Different measures different measures can be used. Different measures can be used to evaluate portfolio performance. Different measures can be used to evaluate portfolio performance, i.e., number one, we have Sharpe's measure. Sharpe's ama Sharpe's? Sharpe's. That is like the SP, Sharpe's of the portfolio. We say it uses standard deviation. It uses standard deviation. It uses standard deviation. First of all, you say the lower the better. The lower the better. So the higher the Sharpe's measure, the higher the risk. We're not interested with the high risk. And that's why we're saying we are happy when the risk is low, the lower the better. Then we might be Sharpe's of the portfolio equals to expected return of the portfolio minus RF divided by standard deviation of the portfolio. Divided by the standard deviation of the portfolio. That's about the Sharpe's ama Sharpe's below the charger. Number two, we have trainers. That is the TP, trainers of the portfolio. Then we say it uses beta factor. It uses beta factor. It uses beta factor. So I think there's a question somewhere which asked about differentiate between the Sharpe's measure and the trainer's measure. CAPM 4 marks. What are the two differences? Sharpe's measure uses the standard deviation and the trainer's the beta factor. The second difference, 8. The formulas. Yeah, there's a difference in the formula, but you can even write the formula and you'll get it right. You don't need a mark to be checked. The most important is that it's real. Amefikiria outside the box. Hapo tunauliza mwenye tumekaa karibu naye, mbona huyu ameandika hivi? Hapo tunasema hapana, ni ukweli mpe. So any other difference that will not lead to somebody laughing? Sharpe's considers the total risk. Trainer's measure only considers systematic risk. Yeah. The standard deviation ya total risk, better ya systematic risk. Yeah. So tumesema kuwa it uses beta factor, right? Yeah. It uses beta factor. Full stop, then you say the lower the better. The lower the better. Then we say that CP equals to expected return of the portfolio minus RF divided by beta of the portfolio. And by the way, do you remember how to get standard deviation of the portfolio? I have it in the notes. That it in the course of the week. Next week, I try. No, this is next week. That you are doing. And the beta of the portfolio equals to, there's an aspect of covariance. Covariance of AM, variance of X. But now that is the beta of the asset, not of the portfolio. Beta of the portfolio equals to weight of A times beta of A plus weight of B bet of B. Ndio, portfolio zimekuja pamoja. Unless kama wanataka tupate trainers of the security. Kama ni trainers of the asset, then you shall use the beta of the asset. Ndio. But if it's about the portfolio, we need the beta of portfolio. Tumesema the lower the better. Number three. Gen 6 alpha. Gen 6 alpha. Then you say it compares expected return of the portfolio. It compares expected return of portfolio with SML. It compares expected return of portfolio with SML. We'll stop then saying if alpha is positive, the portfolio is superior. If alpha is positive, the portfolio is superior. When we say undervalued to superior stroke undervalued stroke super efficient. Undervalued means undervalued means an undervalued investment is a good investment because it has space to grow. That is a superior, super efficient, undervalued. And by the way, story alpha is just an explanation of the decision making ya CAPM. Decision making ya CAPM. If expected return are greater than SML, hiyo ni nzuri. Na kama ni greater than SML, tumesema alpha compares the expected return with the SML. And for that reason, mwambie tu hapo kwa alpha equals to the expected return of the portfolio minus SML. Is the ERP minus the SML. Do you remember the formula of SML? RF plus what? RM minus RF times the beta. Yeah, it's just explaining this. Because if this one is greater than this, then this one thing will give me a positive. If expected return is less than SML, the difference is a negative. So if it's a negative, that's a bad one. If it's a positive, that's a good one. That's how. So in simple terms, we just say the data, the higher the better. The higher the better. We have number 4, information stroke appraisal ratio. So information ratio, appraisal ratio. Information ratio, appraisal ratio. Then you say it compares alpha with unsystematic risk. It compares alpha with unsystematic risk. I.e., mwambie kuwa information ratio appraisal ratio equals to alpha divided by unsystematic risk. Unsystematic risk hawezi calculate, tutapewa hiyo. This one, of course, the lower the better. The lower the better. So sharps, the lower the better. Trainers, the lower the better. Information ratio, the lower the better. Jensen's, the higher the better. So the lower the better apart from the 6. Finally, number 5. We have Modigliani and this difficult name. In M squared. Modigliani and Modigliani. Father and son. Modigliani and Modigliani measure. Then we say it is EIA test by the way. So many lecturers just the same way when it got to lenga the farmer French na pasta until 2020 kakuja watu wanatoka example wanauliza huyo farmer na pasta ni nani? Yeah, so this one also it has never been tested, so examiner can set it for a surprise, but it's something that is very easy. So you just say this: it is an extension of Sharpe's measure. It is an extension of Sharpe's measure. It's an extension of Sharpe's measure, which compares the portfolio, risk with the risk of a benchmark portfolio, which compares the portfolio risk with the risk of a benchmark portfolio. So benchmark portfolio brackets standard deviation of B. That is the standard deviation of benchmark portfolio. Then you say i.e. mwambie kwa n squared equals RF plus Sharpe's. You multiply by the standard deviation of the benchmark. So RF plus the Sharpe's measure, you multiply by the standard deviation of the benchmark. You have the Sharpe's measure. So tunaweza pata formula yake direct. Tumwambie kwa n squared equals to RF plus expected return of the portfolio minus RF divided by standard deviation of the portfolio times standard deviation of the benchmark portfolio. Can be benchmark asset, can be benchmark portfolio, as long as it has the word benchmark. I see some similarity between this formula and CML. Formula CML imepotea. There's some similarities here. RF plus RM minus RF over the standard deviation of the market and standard deviation of the portfolio. Of the security. So mwambie tu kuwa the lower the better. The lower the better. The lower the better. Right. Return of the market, not even of the So just some similarities. It borrows from the same, they borrow from each other. Now, kumbuka your RM is the expected return on the market. So, expected return on the market. Right. I think we've summarized everything in that one now. We dedicate Saturday for doing questions now. Question yala static shafanya sio. So we go backwards now. We can see how many the match will be able to do in that class. Tutasema tumefanya maswali za portfolio. Sio. Then the other class, I think the remaining two topics don't need the the summary of them does not need entire class. Mergers tuna summarize, tunafanya maswali, hiyo ina summary moja. International finance tuna summarize, tunafanya maswali. Ndio. Yeah. We are left with how many classes? 3 or 2? 3, right? 3. Yeah, 3 will do as well. So that next week, portfolio. God willing, if we can do the portfolio to feel comfortable, we can summarize another topic. So that the other week we finish that topic and we summarize the other topic. Hiyo wiki ya mwisho, we don't use the entire lesson to do one topic. At least we also have some moral support that is needed. To me or to you? All of us, Basi, not just you. All of us. So I think you're not badly off. We are left with maswali zai. Ukipata time kidogo mahali, fungua tu past paper, jaribu swali lolote. Sasa when you try, it becomes easier when you're revising. Unasema kumbe hapo ndo penye nilinyoroshwa.